Welcome back, everybody. We are so happy to see you. It's been a minute, so we're excited to be back tonight, take on a new topic. Tonight, we're tackling everyone's very favorite topic, taxes. All right, maybe not our favorite topic, but definitely a very important one, and definitely something that is super important that we all want to learn more about. So we have an amazing presenter tonight, and she has so much to teach us. So I am going to be super speedy so we can hand things over to her. First of all, we just want to start by saying thank you so much to everyone who joined us at WCI Con in Orlando. We had a fabulous week, which we knew we would, but we were particularly blown away by our few happy hour. It really felt like a gathering of friends and a lot less like a networking event or something like that. It really was this feeling of community that we've been hoping for and trying to build here. So it was really, really wonderful to meet so many of you in person and to also get to invite a whole bunch of women who hadn't heard about it yet. So hopefully some of you were there, and we made these cute little few shirts. So if you got one, if you were there and you have one, wear those next time and throw them on. And if you don't have one, we will continue to distribute those through our giveaways and various other ways over the coming months. So keep your eyes out for that. Okay, we want to next tell you about our next live webinar coming up to get it on your general calendar. We have not nailed down a date yet, but we're going to very soon. So watch your email, watch Facebook. We will announce it there. We are taking the summer off because we know how crazy those months are for all of us. So it's going to be in September, most likely the first 2 weeks of September, somewhere in there. So keep that in the back of your minds. Our speaker is going to be Christine Benz. We are so thrilled that she is willing to join us. She's going to talk to us about investing on a pretty basic 101 level so that we all have the foundation that we need to start building from there. So we're super excited to have her join us. She is absolutely incredible. For those of you who know her, she's the Director of Personal Finance and Retirement Planning for Morningstar. She's an author several times over. She's been a keynote speaker for us at WCI Con. It's going to be great. So don't miss that one. Okay, let's get on to why we were here. We're going to move right along. As always, we're going to do a Q&A session after the presentation. So please feel free to write any questions you have in the chat box. Throw those in there. We'll keep track of them, and we're going to do our best to answer all of those after her presentation. And for those of you who haven't been here before, stick around after the presentation. When we wrap up the main situation here, we move into breakout groups. And that is a great place to chat with all the women that are part of this community. You can ask more questions there or just get to know people. They've been really great. So stick around for that. All right. I am so happy to introduce tonight's guest. Our guest is Johanna Fox Turner. She has been partnering with WCI since the very beginning. She's a CPA of 45 years. She is the owner and VP of Fox & Co. CPAs, along with Laura Clifford, who is the president. They and their team serve about 500 doctor clients, 90% or more of whom come from WCI. So she is very familiar with our community and what we believe in. And she has also served as a moderator for the White Coat Investor Forum since its inception. She spends her spare time with her family in the Nashville area, including 6 grandkids, their parents, her sister and partner, and her housemate, Lottie, who is a Blue Merle Aussie Shepherd. So she is also a partially retired fee-only CFP affiliated with another White Coat Investor sponsor, Wren & Company, and they're based in Lexington, Kentucky. So she is just a wealth of knowledge. We're super excited to learn from her. So Johanna, we're just going to turn the time over to you, and you can take it away.
Thanks, everybody, for showing up. This is a rather lengthy topic, so I'm going to do my best to kind of slide through everything, but I don't want to leave anybody wishing they had more information. So please submit your questions, and I'll do the best I can at the end and try to keep this to an hour. Okay, so as I was thinking about what to say, I just thought, the easiest thing would be the top 10 questions that we get from all of our clients who come from White Coat Investor. And Megan said to keep this simple, pretend like you haven't prepared a tax return before, you're just trying to learn how to get started. So I'm going to share the screen. All right, I'm new at this. Can you explain what goes where on my tax return? I will do a quickie what goes where with a sample tax return from a real client who I have kept anonymous, of course, but let's go through this. Let's see if I can make this any bigger. Okay. So this is page 1, and what we are looking at on page 1 is getting down to your total income. And your total income is made up of lines 1 through 7. And for this particular client, they have W-2 income, and it's important to know that W-2 income will be net of any pre-tax contributions to 401ks, 403bs. And so sometimes clients will say, I earned $745,000. Where is it? Well, that's because the net shows on your tax return. Dividends, taxable interest, that's pretty basic, $7,040. So the dividends, what you need to understand is these are the total dividends. Of those dividends, 1,859 are qualified, which means that they are taxed at a preferred tax rate, either 15% or 20%. And below that, we have IRA distributions. Now, this is something that we find clients who are DIY or come from a CPA who's not really familiar with the backdoor Roth may have reported incorrectly. So what you need to look for when you're doing your return is a very small amount of income on 4B. So in this case, $2, and that's from contributing to the traditional IRA. It's sitting there until it clears and earning a couple of dollars of interest. In this case, I believe it was $1 for each client. So if you see $13,000 there or $6,500 there, you need to probably amend your tax return. Okay, capital gains, they had about 6,600. Get rid of some of these boxes. And then additional income, I believe this was from a Schedule C side hustle. Now, we're not going to really go into that right now, but this income, if it's from a Schedule C, is going to be taxed for self-employment taxes in addition to income taxes. So that brings us down to total income of $732,668. Now, the reason I wanted to show you what made up that $732,668 is then that is reduced by either your itemized deductions or your standard deduction. In this case, for this client, let's look at Schedule A if I can pull it up. Their itemized deductions were just under 20,000. So the standard deduction in 2023 was 27,700. So the IRS lets you take the larger amount. This is the case where if they had, wanted to contribute to a donor advised fund, make a 1-year contribution of $35,000-$40,000, they would have been able to itemize. And sometimes we recommend that, and that they skip a year or two of donations and then go back to itemizing. So standard, itemize. All right. So taxable income is $704,953. Now I'm going to go to the second page, and I have a point here for doing this. So the tax on that is $189,312. Now, if I can show you, I've calculated the tax rate, the average tax rate, which was 26% for this client. And that's different from the marginal tax rate. The marginal tax rate for this client would be 37% as calculated on this table. Okay, so the tax tables are built up of lower tax rates, the lower your income is, and then graduating into up to 37%. So this client had taxable income of about $705,000. So their marginal tax rate for any extra dollar of income that they earned would have been 37%. And that's very important to know because 24 to 32% can be ideal if you have a way to reduce your tax rate into those brackets. And that can be done again by, say, a defined benefit plan contribution, your 401k, pre-tax contributions, 403b, 457b. So it's very important to consider those when your employer gives you an option of whether you want to contribute to a Roth 401k or a pre-tax 401k. Roth might be appropriate at any of these tax brackets, but as you go down further, pre-tax would be more appropriate in the three higher tax brackets. And then, of course, you've got to consider your state income taxes. So that goes, of course, on top of that. Okay. So that is a very quick rundown of pages 1 and 2 of your 1040. Now, this is a very common question. Can you explain a backdoor Roth and how it works? And a backdoor Roth is a way for high income taxpayers to move money into a Roth IRA, even though they are not qualified to contribute directly to an IRA. It's a very good tool to use, even though you're only contributing $6,500 a year, $7,000 a year. That adds up if you start early. And the backdoor Roth is a two-step process. You contribute to your IRA, which is non-deductible because your income is above certain amounts. And actually, I've written that down here. If you're single and your modified adjusted gross income is over $153,000, you don't qualify to contribute to a Roth IRA, but you can still do a backdoor Roth. If you're married filing jointly, $228,000 of modified adjusted gross income. And I would pretty much say just use the adjusted gross income from the 1040 that we were looking at just a minute ago. There are a few modifications, but it's easier just to use that bottom number. And then if you're married filing separately, which is what a lot of clients use who are trying to minimize their student loan payments and they're on PSLF, that pretty much applies to everybody. So the phase out for that is just $10,000. And you want to just assume you're going to be doing the backdoor Roth. Okay. And I wish I could take questions. I don't know what y'all need to know about that. When do I need to start worrying about estate planning? Okay, I've got a quick list because that's one of the most common responses we get when we have a client complete a questionnaire or new client complete a questionnaire is, no, I don't have an estate plan in place. Well, not everybody, when they're young and just starting their career, needs a complicated estate plan in place. However, the trigger is usually when you have children, because an estate plan, your last will and testament, determines who is going to be appointed to raise the children if both of you pass away in an accident, and otherwise it's going to be, the surviving spouse. But I still hear the comment from clients, well, of course it's going to be my parents, or of course it's going to be his parents or her parents. Well, if you have, say, $5 million worth of term life insurance, that kind of puts the ball in play that maybe somebody else would like to raise your children, and they would like to go to court and try to present a case to control this $5 million and raise your children. So, in my personal opinion, it's very important to immediately put even a simple estate plan in place as soon as you have children, and if you have life insurance. Second marriages, that's another time that you need to have an estate plan in place, because often one of the spouses will come with prior children, and you may want to make sure that your children get your assets and his children get his assets, but it's kind of dangerous just to leave it up to whatever the courts decide. And that is how it would be determined, the courts and the laws of your state. Another time is as your finances become complex, high, and if you have specific wishes besides, I want to leave this to him, I want to leave this to her. Say, if you want to leave money to charity, if you're helping a family member and you want that family member to have a certain amount of money, it's not going to happen unless you have a last will and testament in place. One other thing that I hate bringing up with clients at times, but it does deserve to be considered, is if one of you dies, especially when you're young, your spouse is probably going to remarry. There's a really good chance of it. That's more typical with the men, in my experience, than with the women. So, not that it's a bad thing. You probably want them to be happy and continue their lives, etc. But you may not want them to share what you've built together and your part in it with the spouse's new family. So that's a good time to consider, we're young. What if something does happen? Let's just put this down in writing and get it settled. Okay. All right. When do I need a CPA? Well, we have some clients that just don't want to bother with it. I mean, they have very simple tax return situations, but they hate dealing with taxes. I hate dealing with my own taxes, so I can totally understand that. Um, just understand that if your situation is simple and you're both W-2s, you're probably not going to get the value out of what you're paying other than the peace of mind and the hassle factor. And to some clients, that's worth it. If you have a side hustle. Now, if it's just, say, $10,000 from filling out surveys, I don't think that's worth hiring a CPA for. But if you have, say, $50,000 you're expected to realize, and that's possibly going to grow, a CPA possibly can help you make certain decisions and find some deductions that you may not be aware of. Real estate. I can't think of a client who's come to us who has done their own real estate K1s and Schedule Es that has done it all correctly. I mean, the depreciation is kind of complicated, and deciding how you separate the actual rental property, for example, from the land that the rental property sits on, and how much you depreciate it, and the lives and the other expenses like a lot of times I'll ask, didn't you travel to this property? Didn't you have meals on the way? Were you out of town? And it's just easy to forget about some of those things. Plus, the real estate can be a rather big hassle factor. If you are W-2 only, I would encourage you, though, to try to do it yourself, at least 1 or 2 years, because TurboTax is fairly easy. And the more experience you have going through the different parts of the tax return and finding out how the numbers travel through the tax return onto the from your W-2, for example, onto the parts of the tax return. If you later decide to use a CPA, you're going to be more informed. You're going to ask better questions. And having that education will help you communicate with your CPA. In the meantime, it's just a good feeling to understand how your tax return works and why you enter a certain number and it ends up somewhere else. And actually, right now, I'd like to put in a plug for the White Coat Investor Forum. We have a great group of very educated and intelligent, financially intelligent doctors and other participants there who help people who don't understand, say, how to fill out the 8606 for the backdoor Roth and just need to have some simple questions answered before you run out and hire a CPA. If that's your only question, I'd recommend going to the forum and just posting a question or lurking and reading a lot of the answers. The forum has a very good search engine, and you can probably find the answer to the question that you have. Sometimes participants will message me directly and say, I don't want to put this out there myself. Will you post this post for me? And then it's kind of got a double layer of anonymity. So please consider that. Okay. How does a home office work? This is another common question that we have. So many doctors that come to us have heard that a home office is an audit flag. Well, I've been doing this for 45 years. I've had one home office audited. It was a client who used about a third of her house for her home office, and it was very legitimate, and we won the audit. But as far as it being an audit flag, as long as you're doing it for the right reasons, appropriately, not taking advantage of situations where you're not sure, you're using a guest bedroom for a little bit of work when you're at home. I think everybody who qualifies should take the home office deduction. Now, a home office has to be exclusively used either for your main work, such as telemedicine, or for administrative work. We have many clients who have a home office for which they use to get away from the rest of the house, read charts, schedule, talk to patients, keep track of their bookkeeping. Totally legitimate. Let's see. Okay. There are two ways to deduct a home office. One is the simplified method, which allows $5 per square foot for up to 300 feet. That means the maximum deduction would be $1,500, which is, in my opinion, hardly worth it. However, doctors tend to have more expensive houses and the ability to have larger home offices, or they pay more in rent, and a rental property that you're living in also can qualify for a home office as long as you're using it for your work and using it exclusively. So today I was going over a tax return with a client, and his home office deduction was $18,000. So much better than $1,500. Of course, this doctor was using 26% of his house for his home office. It was the whole third floor of where he lives. So much better than maxing out at $1,500. Now, it's not going to be that way in every situation, but in most situations, when we are working with physicians who tend to eventually have nicer homes or live in a higher cost section of the country, such as California or New York, and pay a lot of rent, it makes sense to take the actual deductions rather than using the simplified method. It's a little more work. You got to get the information for your CPA or do it yourself, but I think it's well worth it because it also reduces your self-employment taxes, not just your income taxes. Okay. Can I write off my car for work? This is a tough one. I can think of many times we've had clients who come to us and say, well, my CPA or my colleague, this doctor at work, said his CPA said he ought to buy a car for his work and just write it off. It's not that simple. First of all, if you're W-2, it's not deductible at all. Secondly, if you're using it for commuting, even if you're 1099, it's not deductible. However, if you are 1099 and drive the car to various sites to work, then it would be deductible or potentially would be deductible. So the next question is, okay, should my business own the car or should I own it outright? And the answer is you'll get the same deduction either way. So typically, you're going to take a mileage deduction, sometimes actual expenses, depending upon what yields the best deduction. And the time to determine that, if you're able to write off your car for your business, this is pretty common with locums clients. If you're able to write off your car for your business, you need to decide that the first year you buy the car. If you are potentially going to be using actual expenses, which means depreciation, gasoline, insurance, taxes in the future. If you take the mileage deduction the first year, then you can do either one in the future. If you start with actual expenses in the future, you're stuck with actual expenses. So it's very important to sit with your CPA, tax preparer, and have them calculate both ways when you get a new car. That's the primary time that you need to determine how you're going to take a deduction for that car. And those clients who tend to buy more expensive cars and tend to like to trade cars fairly regularly typically do better with the actual expenses. But again, you might want to take the mileage deduction in that first year just to be able to have the choice in the future. Okay. Oh, one other thing. If your business owns your vehicle, rather than you owning it outright, you need to consider that you'll have to have probably have to have a commercial policy for insurance, and that's going to be more expensive. Okay. This has been on my mind a lot lately since we just passed April 15th. Should I be worried if my CPA files for an extension or amends my tax return? Let's talk about the extension first. An extension can be a very good thing for you. First of all, you may not have all your information ready. Secondly, if you have, say, an S corp, a business, and then you have other income, you may want to coordinate what decisions to make with your S corp before you finalize your individual return, because that income flows through to you as an individual, and depreciation is the main area where that can be very important. So say you bought a piece of equipment that, say you're a dentist and you bought some expensive equipment. How much should you depreciate it? Well, you have to compare the personal return to the S Corp return and try to get your tax bracket where you need it to be. So, earlier we were looking at the 24 and 32% tax brackets. You may be able to take part of that equipment as a 179 or a big depreciation deduction and save the rest of it for the future because it's eating into your lower tax brackets. Filing an extension is not a bad thing, is what I'm trying to say. It's not a red flag to the IRS. It also allows you, if you are contributing to a solo 401k, it allows you an extra 5 to 6 months to contribute to that solo 401k. So if cash flow's a little tight because you owe a lot of taxes and you've got that first estimate that's due, an extension can be just what you need so that you can save the money to contribute to that solo 401k for the prior year. And I always recommend you try to fill out the prior year first before saying, I'm just going to forget it and contribute for this year, because once the prior year's gone, it's gone. You can't go back and put money in that solo 401k. All right, amended return. When do you file an amended and how do you decide? Well, if you've made a mistake, of course, you're going to need to file an amended return in most situations. If the mistake is minor, you may talk to your CPA and maybe the CPA made a mistake and you're going to owe another $50 or you're going to get back $100 and the CPA is going to charge you $800 to do the amendment. I probably pass on that. Another consideration when you file an amended return is that it extends your statute of limitations with the IRS. So the IRS has 3 years from the due date of the filing date of your return, or 2 years from the day you pay your taxes to audit you. But if you're 2 years out and then you decide to amend your return, then you have another 3 years from that date for the IRS to audit you. So it's something you need to consider before you decide to amend if it's unnecessary to do so. Another thought on amended returns is a lot of doctors, as I mentioned earlier, file married separately to lower their student loan payments. You may want to later on change that to married filing jointly, and you can do that. That's an amended return. Now, if you file married filing jointly and the due date is passed for that return, you cannot go back and change it to married filing separately. So something to keep in mind. If you need to file separately, go ahead and do it with your first filing or amend before October the 15th. So to answer that question, if my CPA files for an extension or amends my return, I think there's a lot of hand-wringing over this that is really not necessary. Many times it can help you coordinate your taxes, have a lower tax bill, just by taking time to study the numbers and how they impact each other. Okay. Why do you consider a solo 401k superior to a SEP IRA? To me, this one's pretty obvious, but most CPAs recommend SEP IRAs. And I think it's important that white coat investor readers are aware of that, and also aware that it doesn't mean your CPA is dumb or just doesn't understand the tax code. It's just the way they've always done it. And certain doctors, mostly those to me that are involved with white coat investor, understand that a SEP IRA can cause you to pay pro rata taxes if you're converting to a backdoor, converting to an IRA, a Roth IRA in the backdoor Roth IRA process. So one reason not to have a SEP IRA is because of those pro rata taxes. Another reason not to have a SEP IRA is that you don't get a catch-up contribution when you turn 50. So SEP IRA this year and a solo 401k this year, if you're under age 50, you can contribute $69,000 if you have enough income to justify that. Once you turn 50, you can contribute another $7,500 to a solo 401k, but the SEP does not have that provision. So you will have a lower potential to save for retirement if you have a SEP versus using a solo 401k. Another reason for that I'm not a big fan of SEP IRAs is that they're totally funded by the owner of the practice, by the employer. So if you have other employees and you want to contribute the max to your SEP IRA, which is 25%, you have to do the same for every single employee in that practice. And that can get kind of expensive. Let's see, burden falls. I think that was all I had on that. Oh boy, this is a whole can of worms. Should I get into real estate? When? What are the tax consequences? What I'm going to say here is my opinion and my opinion only, because I know I differ from white coat investor a little bit on this. But I'm not a huge real estate for doctors fan. That doesn't mean I'm not a fan of real estate for any doctors. If you have a passion for real estate and I've told clients before, if you eat, live, and breathe real estate and it's just your passion in life, go for it. When? Not until you can fill out all of your other retirement accounts and you have a good start on a taxable account, in my opinion. Now, why am I not a huge real estate fan? Well, I wrote down a few reasons here. Number one, it's not diversified. It's very concentrated into one sector, real estate, and it assumes that you know better what you're buying than the person or the organization you're buying it from. Or if you are, you pick out a single family home or 4-door, whatever, that of all the properties available, that you picked the one that was going to have the best returns. You're also assuming that you can beat the market with real estate. It's also quite illiquid, and the tax benefits from owning real estate are usually deferred. Now, that said, we have had clients who have done well with real estate. So I'm not going to turn up my nose to somebody just because they have real estate, but I do want to present both sides of the story because I think real estate is a little faddish right now. It can be a good thing, but I don't see many clients measuring their long-term returns in the real estate that they own against what they could have had in a simple, diversified, low-cost equity portfolio, mutual funds and ETFs rebalance periodically, which, and again, in my opinion, is the true passive investment. I mean, that's one of the easiest things that you can invest in. I'm kind of putting on my financial planning hat there. Okay. S Corp. This is one of the first questions we're asked when a prospective client or new client comes to us is, why shouldn't I have an S Corp, or why shouldn't I have already set up this S Corp? Because sometimes we get clients who will come to us and they say, well, I just heard it was the thing to do. It's not necessarily the thing to do. We have many, many clients who are sole proprietors because they don't earn quite enough through their side hustle or their main job to justify an S Corp. But there are times when an S Corp does make sense. One time is when you have employees, because an S Corp provides a layer of asset protection for the acts of those employees. I think it's important to know that an S Corp does not protect you, the owner, and the professional. But if you send someone out for lunch that works for you for the whole office and they have a wreck and kill somebody, that could come back on you. And the S Corp can provide protection for that. Another time is when it makes financial sense. Typically, $350,000 to $400,000 is what I look for in gross income, plus the salary of the owner, to justify the S Corp, because the only thing that the S Corp provides is a savings of Medicare taxes on distributions. Now, let's say you want to have a defined benefit plan, you don't have any other employees, and you want to sock away as much as possible in that defined benefit plan, which can be several $100,000. An S Corp possibly is not going to be the best choice, because what you can put into that defined benefit plan is going to be based upon the salary that you take out of the S Corp. And that higher salary negates the benefit of the Medicare tax savings on the distributions. And I know this is kind of a complicated area, but bottom line, I would say, don't always assume that you need an S Corp or you should form an S Corp just because you're in business, just because you have some self-employed income. But also understand that some payors are going to require, especially in California, require you to be an S Corp regardless of how much money they're paying you. So in that situation, you really don't have a choice if you're going to do work for that entity or that person. Let's see if I had anything else. So for all of our clients who are considering being an S Corp, we always run a cost benefit analysis, because we want to make sure that the Medicare tax savings that they realize from the distributions they're taking from the S Corp are able to overcome the additional cost of being an S Corp. And that additional cost, first of all, it's your CPA. So you need to know that these savings are going to be able to pay for the CPA, for the payroll service, and compensate you for the extra complexity of just dealing with an S Corp. because it's not nearly as easy as it is being a sole proprietor.
All right, Johanna, thank you so much for going through a lot of those popular questions that you're seeing frequently from doctors, because I'm sure many others have those same questions here on our webinar tonight. A couple of questions that have been posted in the chat, and if you have other questions you've thought of, go ahead and post them in there, and we will ask them to Johanna. Or you can also stick around for our small groups after, and we can have a few more discussions on that. The first question, can you explain the advantage between alternating between the standard and itemized deductions year to year?
Yes, I'd love to do that. I think I kind of glossed over that. So the standard deduction is much higher than it was 8 years ago. I don't know exactly when that changed, but last year was $27,700. If you have, say, paid off your mortgage, or you don't have a mortgage and you don't have interest to deduct, and you're not giving much to charity, but you have a goal of giving money to charity, then it's better to bunch those charitable deductions. So if you typically, let's say you give $15,000 a year. Well, if 15,000 plus some SALT taxes, which is state and local income taxes, get you to 22,000 in a year, the standard deduction's higher, so you're going to want to go for that. But if you're budgeting $15,000 a year for your donations, then it would be better if you bunched those donations in 1 year. So say 45,000 in 1 year, take the itemized deductions, and then go back down to the standard deduction for the next 2 years until you are ready to give again. And that way you're going to get the most out of your itemized and your standard, and your standard deduction.
Okay, excellent. Are there any others besides, charitable contributions is usually the biggest. Are there other ways? And, I think some states will allow you to prepay taxes so you can get
Yes.
the taxes, property taxes or state taxes both in the same year.
Yes, so some state, and it's very important to understand what's going on with your state. If they've passed a regulation allowing you, if you are in an S corp or a partnership, to pay taxes through that S corp or partnership, so that you don't have such a high lost SALT deduction. So your SALT, state and local income taxes, on your itemized deduction is limited to $10,000 only. Well, in Texas, you're going to pay more than $10,000 probably for your real estate taxes. But Texas doesn't have a need for the pass-through entity tax. However, California is a great state to take advantage of the pass-through entity tax because their taxes are so high. So you've got a lot of state income taxes, you've got a lot of real estate taxes, and small amount of sales taxes. So I've seen clients with, $60,000, $70,000 of SALT taxes, only able to deduct 10,000. So the pass-through entity tax, if you are part of a partnership or an S corp, you can have those taxes paid through the S corp or partnership and pass through to you as a credit on your personal tax return. Very beneficial.
Okay. Thank you. The second question that we have is it better to pay taxes now by doing Roth contributions as to paying them in 20 to 30 years when taxes will likely be higher by doing pre-tax? The big Roth versus not Roth.
Yeah, I am a huge Roth cheerleader. That doesn't mean that I tell all my clients, regardless, if you have that option through your employer, just to sock it all away in a Roth. But I do get that question and say, why don't you do 50-50? My point of view on that is, taxes may be higher in the future. They may not be. You don't know what your tax bracket's going to be in the future. But what I believe is that once you get to the future, you're going to be so happy that you have as much as possible in a Roth IRA and a taxable account, because I've seen these older clients having to take required minimum distributions, and it's not fun. With the Roth IRA, you don't have to take required minimum distributions, and you have so much flexibility. Plus, a lot of doctors want to retire early, age 50, age 55. Well, if you have a 401k at age 55, you separate from service, you can start taking those distributions, but you're going to pay tax on them. Say you want to retire at 50, you're going to have something to live off of. And a Roth IRA, you can take out your original contributions at any time. A taxable account, I like almost as much as a Roth IRA right now, because you get a step up in basis. When you pass away, your heirs get a step up in basis. And while you're alive, you have basis in that taxable account, and you have preferential tax treatment for long-term capital gains and qualified dividends. Does that make sense?
Yeah, I think just for people to understand, it's good to have both pots of money, because then you have a lot more flexibility to really
Yes.
pick your tax bracket once in retirement based on where you're pulling money from, and not being forced to make these
Yeah.
required minimum distributions.
Yeah. And I have a kind of rule of thumb. I like to see clients aim toward 1/3 Roth, 1/3 taxable, and 1/3 pre-tax in retirement. Not necessarily right when they retire, but to have a goal of to start doing some Roth conversions to get to that point. Sorry, interrupt.
No, you're great. And we had a engineer, Christopher Davin, that actually gave a whole hour-long talk on this, really diving into the weeds at this last year's conference. And then he was recently on the podcast. So go listen to that if you really want to understand some of the nuances of that question. Here's another question. It says, can you give us your thoughts on a Roth 401k versus a traditional 401k, not in a high-paying specialty and early career? Which is better?
I don't.
I guess it's really sort of the same question
context there. Yeah. Probably based upon what I just said. Early career, you're going to have longer to grow that Roth if you can pay the taxes. And to get back to, I mean, you're not going to get that tax deduction now, but what often happens is you put it in the Roth, you're forced to pay the taxes. You put it in the pre-tax, you save that, on the taxes, but that extra money kind of slips through your hands, and it's not often tracked and saved.
Yeah.
For the future.
Okay. Thank you. Question here that was asked is how is estate planning different from a trust?
Well, a trust is, I get this question so much. Clients will say, do I need a trust? And my response will be, why? Do you understand a trust? Well, there are two kinds of trusts. The permanent trust and the see-through trust that becomes permanent at death. So a trust is a part of estate planning, but estate planning is not all about trusts. So a trust can protect your assets if you have a permanent trust, or it can make your probate easier once you die if you just have a revocable living trust. Thank you. So revocable living trust provides no asset protection, but it allows you to retitle your assets into the revocable living trust so that you protect those assets from having to go through probate. I think this is oversold by attorneys at times, because in some states, probate is so simple, and the just dealing with retitling assets into your revocable living trust doesn't always happen, and it can be expensive.
Right. And a lot of times you also have to look at what the estate tax exemption is at the time, based on what you think your estate will be. If you're going to be under whatever the state tax limits are, a trust is less needed in those circumstances too. And so it depends on your state.
Could I address that just for a second?
Yeah, go ahead.
Okay, at the end of 2025, the tax laws are going to sunset, and the huge estate tax exemption that we have now for federal is going to be cut in half, basically in half. And that means right now it's 14 million plus per person. It'll go down to 7. I haven't looked it up lately, and I don't keep those numbers in my head. But if you have, say, parents, family members who have significant assets, they might want to look at an irrevocable trust because they could move potentially $7 million totally tax-free, and they get to keep that when the estate tax exemption goes down by 50%.
Yeah. So definitely something to be watching what those limits are. I know personally we did that because a couple of years ago was threatening to drop sooner than it ended up doing it, just so you could take advantage of the higher limit with the state taxes. Another question is, if you don't have children, who gets your stuff according to the law if you don't have a will or a trust in place?
That's called dying intestate, and it depends upon the laws in your state. They vary in every state.
Okay. How do you find a CPA that is savvy with doctor situations, and what kind of questions should you ask?
I've written an article for the blog, and you can look at that article. Would be the fastest way. It's been several years, but I reread it lately, and it's still pretty relevant. The thing with the white coat investor is it's a small niche group of doctors, and they all are much more financially literate, sometimes than CPAs who aren't exposed to the side. So one thing you don't ever want is a CPA who's going to argue with you, say about a backdoor Roth, or argue about, no, solo 401k is not appropriate, it's too complicated, you need to do a SEP, and who kind of are set in their ways and won't be open-minded to what you're teaching them. But then again, you don't need to have to teach your CPA.
Okay, thank you. And some of the questions that have been asked were sort of tied to specific situations that we may not be able to dive into. I'm going to ask a couple sort of general ones that hopefully can answer other people's questions. So in a circumstance where you have both 401ks and IRAs, it doesn't make sense to do a Roth conversion because of the taxes due at this time. Is it better to wait if you're close to retirement to then do Roth conversions at that point?
It depends on your tax bracket. It depends upon your goals. I've said many times on the forum that the pro rata tax is not necessarily a bad thing. You're not being penalized. You're just paying taxes on a part of your pre-tax IRA now rather than later. But I think a lot of doctors miss the fact that they can probably roll that IRA into their work 401k or their solo 401k or their work 403b, and they just don't know to check the summary plan description.
Okay, yeah, that's a good pointer to check on that rolling over before you have to do a conversion.
Exactly.
But certainly, if you're doing a conversion, trying to do it when you're in a lower tax bracket.
Oh.
If
One more thing, if I could say, either in a lower tax bracket or when the market really drops, because you're getting the same impact by converting when shares are a lot lower.
Okay. Excellent. When does it make sense to put your spouse or children on payroll if you're a 1099 contractor?
Oh, mercy. Your children have to do work that you're paying them a reasonable amount for. And you need to have a contract. You need to make sure that they do the work, document, etc. Now, spouse, I hate to say this, but a lot of doctors have spouses who are stay-at-home parents, which is wonderful, but they put them on the payroll in order to allow them to contribute to their 401k, whether it's a solo K or whether it's a work 401k. Now, to do that, the spouse is paying, actually, the couple is paying FICA taxes, 15.3% on the first almost $170,000 of income. That's like a 15.3% front load in order to put money into a 401k. Now, I don't know of anybody I could talk to who would want to pay a front load of 15% to put money into an investment account. So I'm really not in favor of doing that.
Here's one about 403 contributions. Should I do half Roth, half pre-tax? Is that sort of the same thing between, as you would do your 401k, trying to split it?
Yeah.
Okay.
Yeah, if you're not sure, you kind of want as much as possible in a Roth, but you want the tax deduction now, just split it. And then, you can always change it.
Okay. Another question that just got posted. Is it worth using an employer HSA instead of a personal HSA to save payroll taxes?
Very little difference. I mean, you're going to save Medicare taxes, but use your contribute to an HSA if at all possible. To me, that is the premier way of saving money for the future. You just don't get to put much in, but you get a deduction now, you get it tax-free on the end, and it grows tax-free. So it's like an IRA on the front end and a Roth IRA on the back end. So don't spend those HSA dollars, please, whether you use to do it yourself or you do it through your employer. And also be aware that if you contribute through your employer, you don't have to leave it in their HSA provider. You can move it to a provider of your own.
Yeah, the best account out there, triple tax free. So it's great. Cindy posted in the chat that article that Johanna mentioned about how to find a great CPA, or you can also search, if you lose it out of the chat, that's what it's called, how to find a great CPA. You can search for it on the White Coat Investor website. Thank you so much, Johanna. I'll turn it back over to Megan to give a couple little final notes, and then we'll split out into our discussion groups.
Perfect. Thank you both so much. And again, a huge thank you to Johanna. Amazing. Your wealth of knowledge is very vast. So thank you for spending time with us, helping answer our questions. Okay, our last step tonight before we go into breakout groups for more discussions is just our giveaway. So we'll be doing this the same as we did last time. You can head over to the Facebook group, and we want you to tell us one thing you learned tonight that you're going to implement in your personal or your business tax plan. And then we will enter you into our drawing for one of our few shirts and WCI Yeti. We will announce winners next week. And as always, if you don't have Facebook, just email your answer to us at few@whitecoatinvestor.com. And at that same email address, feel free to reach out anytime with questions, comments, recommendations, or anything else that you want us to know. And if you are out and about in your few shirts, if you are one of the ladies that attended WCI and WCI Con, and you already have a t-shirt, take pictures of yourself out and about in the world and send it over to us, and we will feature you on our social media channels and such. So, okay, we're going to divide into our breakout groups now. And as a reminder, we never record the breakout sessions. So we will turn off that recording before we send you all into your group so you can feel free to discuss without worrying about being on film. And we will not be coming back together after those discussions. So if you are not planning on sticking around for that, you are free to go, and we will see you in September when we are back with Christine Benz talking about investing. And just as always, thank you so much for coming. We're so thrilled with this community and the way that it's growing. We are already nearly at 2,000 members, and it just wouldn't be anything if all of you didn't keep showing up and participating. And so we just are so thrilled. So thank you so much. We'll see you next time.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.